This stock market crash. Are we at the bottom? The short answer, no. And I'm going to explain why in 3 simple, fast steps. Step number 1, let's start with the market cap to GDP, or the Buffett indicator. On the left, the percentages go from 0 all the way up to 160% market cap to GDP. Starting at 1970 all the way to 2020. In 1970, around 80% comes crashing down to a low in 82-83 where it's dirt cheap, 34%. Goes up a little bit, pretty flat from 1990 to 1995. Then it goes parabolic to the huge dot-com bubble we had in 2000. Comes crashing all the way down and goes back up. The Fed inflates another bubble. That deflates and comes down in 2009 or so to 56%. Again, very cheap. Then what happens? The Fed comes in with quantitative easing, 0% interest rates, all the funny money, and the stock market goes up to an even higher level than it was in 2000, 142%. So it's pretty easy to understand what's going on here. If you just draw a straight line from, call it 65%, straight across the chart, anything below that, and you're in the cheap zone. Once you get to a point of maybe 100 and higher, now you're in the expensive zone. And if you get above 120, in my opinion, you're in the no bueno zone of the market cap to GDP. That is a bubble. A couple key takeaways here. First and foremost, I'm talking about the broad market, just as a whole. Even though we're at all-time highs or maybe we're at all-time lows, it doesn't necessarily mean that an individual stock or asset, real estate, is cheap or expensive. Let's look at real estate as an example. Going back to 2006, we know that was the top of the bubble. 2012, it bottomed out. But if you could have got a 2012 type deal in 2006 or in 2020 when the market was just as high, you got to pull the trigger on that. Likewise, if you were in 2012 and you saw a house, a real estate, a property that was massively overvalued, it doesn't necessarily mean that the individual asset is a good deal just because the market is quote unquote cheap or expensive or even in a bubble. Let's take the real estate example one step further to prove another point I always try to make. If you look at the real estate chart, I always use going back to 1900 adjusted for inflation. You'll see that we peaked out in 2006 and we were in a massive bubble. No one would dispute that. But prices in 2020 went up just as high, if not higher, than 2006. So if we were in a bubble in 2006, how could we not have been in a bubble or are in a bubble in 2020? The exact same thing for the Buffett indicator. If we were in a bubble in 2000, and no one would dispute that, how were we not in a bubble 2 months ago when the market cap to GDP was even higher than it was in the dot-com bust? And it's not just me saying this. Editor, let's cut to the clip of Jim Chanos yesterday on CNBC.
Every idea stands on its own merits. Valuation is an important part of that. So if valuations are down, then we'll be less likely to do something. Having said that, as I said at the outset of our conversation, there's lots of situations where the valuations are still excessive and kind of shockingly so.
Let's look at a poster child for exactly what Jim Chanos is referring to. It's a company I always use as an example, Uber. Right now, the stock is trading right around $21.93 as we're filming this video, about half of its all-time high. So you may say, George, wow, that's really come down a lot. It must be cheap. Right. Think again. Look at its earnings per share, minus $6.81. And if we scroll down further on the right, look at their earnings. They had $14 billion of revenue in 2019, and they lost $8.5 billion. How? How is it possible to incinerate that much money? And even though this company loses a massive amount of money and will most likely really struggle going into a recession or a depression, we still see that the market cap is $40 billion. How is that possible? $40 billion with a company that's really going to struggle for the next 6 months to a year at best. And last year in 2019, it made the most revenue it's ever made, and it lost over $8 billion. This is an example of the market coming down a lot, the share price coming down a lot, but it doesn't necessarily mean that the individual asset is cheap. Let's go back to the chart of market cap to GDP. When we hit the all-time high of approximately 142%, that was back in 2019. This chart isn't totally up to date. So where are we now? Editor, let's go ahead and throw up the next chart. This is another way of looking at the Buffett indicator, and it's really interesting. Instead of showing us a percentage, it shows us two lines. The green line is GDP. The blue line is the market cap of the stock market. So check this out. When the stock market or the market cap is below GDP, that's when things are usually pretty cheap, or at least reasonably priced. When we get into a bubble is when the market cap exceeds the GDP substantially. Of course, that makes a lot of sense. Well, look at where we were back in 2019. Look at the delta between the green line and the blue line at its peak. Unbelievable. How could you look at this chart and not say we were in a massive bubble? And again, let's compare where we were to 2000. It's just blatantly obvious that the market was wildly overpriced. So you may be asking yourself, okay, fine, George, I get it. Where are we now? Let's go right up to the upper left corner, and we see that we are at 116%. Still not anywhere close to cheap. In fact, according to this website, Guru Focus, the stock market is still significantly overvalued. And when you look at the current market cap to GDP of 116%, and you extrapolate that into the future, meaning what are the expected returns over the next decade if we're at such a high level right now. And it's likely that over the next decade, we'll only see a return of 1.5% a year from this valuation, and that includes dividends. As pointed out by Warren Buffett, this chart is probably the single best measure of where valuations stand at any given moment. Step number 2, the CAPE ratio. Let's check out another chart that's extremely important and kind of layer this and add this to our thought process when we look at the market cap to GDP. It starts with a 0 price to earnings ratio and goes up to 40. And we take it all the way back to 1880. As you guys know from watching my videos, I love charts that go back into the 1800s. Takes us all the way to where we are today, 2020. This is actually an updated chart. Editor, go ahead and actually throw up the chart of the CAPE ratio. And for the viewers, I want you to notice that it is different, quite a bit different than the way I drew it. Let's come right back to my drawing on the whiteboard. The big difference is I just put dots at a mark where the PE ratio was or the CAPE ratio was during that specific year. I did it so it's easier to see where the average is. So we can draw this line right around 15 or 16 and know that anything above that is most likely getting into the expensive zone. Anything below that, and it's getting pretty cheap. The way I saw it in my mind are these two pyramids. And as the pyramid gets closer to the top or bottom, it grows, implying that it's either getting more and more and more expensive or more and more cheap. So right around 17 on the CAPE ratio, we're doing okay. But once we get into the above 20, it's expensive. Once we go above 30, we're definitely in a bubble. On the flip side, if we're down around 14, that's okay, not bad. Once we get down below 12, pretty darn cheap. And if we get anything below 10, that's when you back up the Brinks truck. So where are we today? 23.8, which is definitely expensive. And keep in mind, this is all the way down from plus 30. Back at the peak, I think it was around 30, 31, 32. So it has come down dramatically. But at 23.8, it's still expensive. Definitely nowhere near cheap. I'd also like to add that on a moving forward basis, I think the business climate is going to be far less friendly. To get an idea of what I'm talking about, let's go right back to the interview with Jim Chanos.
I think the gig economy companies are going to come out of this harmed, not enhanced. I know there's a body of thought that, oh, well, everybody will just do food delivery and we'll all take Ubers and no one's going to buy a car again. And I think that the flip side of it is that the labor pool issue for the gig economy companies is going to loom very, very large coming out of this crisis. Keep in mind that we as taxpayers are paying, correctly so, the unemployment benefits for a lot of drivers, Uber, Lyft, Grubhub, and so on. And but the reason we're paying that is because the companies themselves never paid into the unemployment pools. It's the whole idea of keeping employees as independent contractors rather than employees. And I think both political parties are going to be looking at that pretty hard coming out of the crisis to enhance corporate responsibility in lots of different ways, whether it's keeping employees as independent contractors, whether it's restricting buybacks. There's lots of issues yet we haven't thought through about this that I think will make a difference to U.S. businesses.
So this video isn't about whether or not the gig economy workers should be full-time employees or 1099s. But what I want to point out, and like Jim said, on a moving forward basis, I think we're going to have a lot more regulations in the business environment. There's going to be much fewer buybacks, which remember was the main driver of the stock market getting to all-time highs since 2010. And the question I would have is, what are the animal spirits going to be like once we get through this recession, especially if it's caused by a pandemic? And what I mean by animal spirits, it's just an economic term for entrepreneurs wanting to go out and actually take risk by starting a business. It's the SMEs that drive this economy, the small and mid-size enterprises. And once we go through 6 months or a year of dealing with a pandemic, how many individuals are going to want to go out there and take their savings and risk it all? Probably a lot less than we had in 2019. And that means a much less dynamic economy moving forward, which makes the 23.8 on the CAPE ratio seem even more expensive. Step number 3. Does buying things when they're cheap even matter? We know that the stock market is still extremely expensive, and we most likely haven't seen a bottom. To reiterate, there are no certainties, only probabilities. You guys know that from watching my videos. We could go to an all-time high tomorrow. Who knows? But the probabilities are very low. We most likely haven't seen a bottom. But Does buying things when they're cheap even matter? Maybe it's irrelevant. To find out what the numbers say, let's go right to my favorite website, georgegammon.com. This is from a blog post I did in 2019. And just FYI, for any of you who would rather read than watch one of my videos, a lot of the videos, the whiteboard videos I do on the YouTube channel, we actually transcribe and put them right here on the blog, the Rebel Capitalist blog. The transcription, it's a little weird, but you can get the gist. So if you want to read something, make sure you check out the Rebel Capitalist blog at georgegammon.com. But that's not my point right now. My point is getting back to the CAPE ratio that I used in a blog post from 2019. This is a study I did where I compared buying the market when it was cheap compared to when it was expensive. The first numbers that I crunched, and keep in mind, this is the compound annual growth rate. This is not the annual rate of return. If any of you guys don't know the difference, make sure you check out my video on how the financial industry is completely pulling the wool over your eyes by using the annual rate of return. It's all about the compound annual growth rate. Now that we've got that out of the way, let's go to a spreadsheet that starts at 1929. This assumes you invested $10,000 adjusted for inflation, and it adds dividends. At the end of 10 years, so 1939, your compound annual growth rate would have been 0.81%. So your total balance would have been $10,840. You can see how it changes from decade to decade, and at the end of 60 years, you'd have roughly $309,000. Let's do the exact same thing, but start at 1920, which was a low on the CAPE ratio instead of one of the all-time highs. After 10 years, your compound annual growth rate would have been almost 13%. The original investment of $10,000 would have grown to $33,000. And you can go down the column and see that the compound annual growth rates are much higher when you compare them to starting in 1929, which was when the market was extremely expensive. At the end of 60 years, instead of $309,000, we have almost $600,000. And keep in mind, this is just one example of when it's better to buy low and sell high than to try to buy high and sell higher. If you look at individual stocks, if you look at markets around the world, usually this is the way it works out. So if you have a diversified portfolio where you don't have all your eggs in one basket, you buy things when they're cheap, most likely in the long run, you're going to do well. So the takeaways are whether you're buying the broad market or an individual asset, make sure you're buying things when they are cheap and selling them when they're expensive. And the overall market right now is extremely overpriced. So in my opinion, the probabilities are high that we have not seen the bottom in this bear market. But I could be completely wrong. The Fed could come in and buy every single stock in the entire S&P, buy every mortgage, buy every bond, and prop up the price to infinity and beyond. Let me know what you think in the comments below. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.